We are midway through the trading week and time for another Targets in Focus interview. Peter Dragicevich of Commonwealth Bank of Australia is on the phone with me now to discuss Asia-Pacific pairs. Peter, what are the current drivers of the Asia-Pacific currencies? What should traders partial to these pairs be looking out for?
Well, has been a trend over the last probably 18 to 24 months. Market volatility has been quite low. When you have a low volatility environment, the relative economic fundamentals become more prominent drivers of the currencies. So in that aspect, New Zealand and Australia's economy are still performing relatively well. We still have very attractive interest rates as well. So on a risk-adjusted basis, the carry provided in those currencies is still quite strong. Over the next week, probably the key events to look out for in terms of the Aussie dollar, we've got the Q1 Australian CPI out next Wednesday. We're expecting that number to be relatively benign, so we're expecting the underlying inflation rate to come in towards the middle to lower end of the RBA's target band. So we're not expecting it to adjust market expectations about further RBA policy easing, but probably the bigger event is the Reserve Bank of New Zealand's meeting on Wednesday as well. We're not expecting a change there, but one thing to keep an eye out for is the commentary around the currency. At the last meeting, the RBNZ released an alternative set of forecasts which suggested that if the New Zealand dollar was to appreciate further, they could look to cut interest rates to try and offset some of that impact. So, and since then, the New Zealand dollar on a trade-weighted basis has actually appreciated by over 3%. So we're expecting quite a bit of jawboning from the RBNZ next week. So the Kiwi may come under some downward pressure towards the middle to second half of next week.
The Aussie dollar recovered swiftly and continued on the upside following the Reserve Bank of Australia's announcement on Tuesday that the economy could require further rate cuts in 2013. Should this happen, would this have the desired effect on the Australian currency of bringing it down to an export-friendly level? And how does the possibility of further central bank action shape your forecast for the Aussie dollar against the US dollar over the short, mid and long-term period?
Well, in terms of the RBA's commentary, the easing bias that you indicated has been in place for a number of months now. So it wasn't overly new to the market, hence we didn't see too much reaction in the Aussie. In terms of our outlook, we don't expect the RBA to cut rates any further. We expect 3% to be the bottom of the cycle, but if they were to cut rates once more, we wouldn't expect that to have too much of an impact on the currency. As I mentioned earlier, our interest rates are still relatively attractive on a global basis, and currencies are a relative price. So as we've seen, the RBA has cut the cash rate by 175 basis points so far since November 2011. And that really hasn't put too much downward pressure on the Aussie dollar. So we wouldn't expect another rate cut to have much of an impact. And going forward, we think the more important driver will be the outlook for the Asian economies, particularly China. We're quite positive and expect the Chinese economy to perform relatively well. That will feed into Australia's economic performance, and hence we expect the Aussie to remain around current levels over the remainder of this year.
Moving on to the New Zealand currency, what response have we seen in the Kiwi dollar to New Zealand's consumer confidence data released overnight? Does this data support your forecast for the New Zealand dollar against the US dollar?
We didn't see much reaction in the Kiwi to the data. Really, in our view, what's really going to drive or support the New Zealand dollar going forward, and as it has done over the past 12 months, the flows into New Zealand. There's still a lot of reinsurance inflows that need to flow into New Zealand associated with the Christchurch earthquake, and the level of foreign demand for New Zealand government bonds is still quite strong. So those inflows are very supportive for the New Zealand dollar, and the New Zealand's economy continues to perform relatively well. There's a lot of rebuilding that needs to be done in Christchurch, and that should be a supportive factor for the New Zealand economy. So really, they're the main factors that we think will be New Zealand dollar supportive going forward over the next 12 to 18 months.
And lastly, while the Japanese yen has been maintaining highs, it was interesting to see the dip it took during the New York trading session in the wake of the Boston bombings. Is this an indicator of the part US markets have to play in yen pricing? And how does this impact your expectations for the dollar yen?
I think the impact or the Boston bombings were just added to the negative market sentiment on that day. We did have the weaker than expected Chinese economic data released earlier on, and obviously the incident in Boston just compounded that risk aversion, and typically the yen does strengthen in those types in those periods of risk aversion. So and as we've seen over the last 24 hours after that event, the yen has started to weaken once again. Now, our view is that the yen is structurally depreciating. We've seen the current account surplus in Japan shrink from around 3.5% of Japanese GDP pre the earthquake and tsunami, and it's now just under 1%. Now, that's a lot of natural demand for the yen that's declined, and that's really been the key structural driver behind the weaker yen. And obviously the BOJ, or expectations around BOJ policy, is just adding to that momentum. But going forward, we think dollar yen should continue to lift, and we wouldn't be surprised to see it trade above 100, up towards 110 over the coming months.
Thanks, Peter. Coming up today on Dukascopy TV, we'll be bringing you exclusive insights into the Bank of Canada rate decision as well as UK CPI data. But for me, it's goodbye for now.